currently recording. Okay. So, light in the video. Good enough. So everybody's fired up? What would you guys say as you were walking in? Are we all excited or something like that? Pumped up? I hope so. Yeah. So, how many have not read chapter 5? How many have not read chapter 6? Oh, no, that's not good. We're starting 6. Okay, but at least everybody's 5 and almost everybody is 6. You guys sort of got a wake-up call? Maybe a little bit? I got an email that said that a whole bunch of people are asking for tutors and they don't have enough tutors, so I'm going to give some names of some folks who were moderately successful in 211 to the Academic Resource Center for other tutors. What I would warn you about with tutors is they won't do you any good either. Them knowing it won't do you any good either. They might help you to know it if you actually learn it when you talk to them. I'll help you to know it if you listen to me, if you come in here all fired up to learn it, and you're paying attention, right? And after you've read, before we cover it, and all those things, right? So you're into it. How many of you worked a bunch of problems this week? Okay, that's a smattering, that's something. Is that hard to do right after you do the test? To get yourself motivated and get yourself going? Yeah, but that's exactly what you need to do, right? If you didn't before, get going, get going. So anyway, all right. I know you guys are all intelligent people. I know you are all capable of hard work, and I know you will all accomplish this. Okay, well, the vast majority of you will. And some of you will come back and do it later, or some of you will decide to do something else, and that's what we'll do. Okay, it's not a thing for you. I think you all have the aptitude, certainly, to do this. Right? I know you. Okay, that's not an issue. So if you decide you want to do something else, that's all right too. That's what college is for too, right? That's okay. You can go in a different direction. So anyway, let's talk a little bit about chapter 5. You read it and you're kind of like, well, there's not much in here, I hope. You felt that way? I kind of feel that way about that chapter 2, but it's a little bit of a break. They try to show that there is indeed theory behind all this accounting stuff, which there is. It's really economics, economic theory, right? Which is a type of philosophy, kind of. No kidding, right? Everything's based in philosophy. Did you know that PhD, you know what it stands for? How higher and deeper, right? Everybody says that, okay, which is true. You know what we're talking about, higher, right? It's real narrow. But it's what? Doctor of philosophy. Yeah, doctor of philosophy. Everybody with PhD is a doctor of philosophy. We're all a bunch of philosophers. And in a sense, it's kind of true, right? Different philosophies of how the world might work a little bit. And so economics, accounting is certainly based on economics. Finance is based on economics too, right? They're just more practical versions of economics. So what's interesting to me too is students a lot of times I was on this. I didn't like economics, but I liked accounting. That's really not even possible. You really don't understand accounting very well if you don't understand economics. And the reverse is kind of true too, which is a little weird. Right? It's kind of true. If you don't have any practical applications for economics, well, what's economics about? So it doesn't have to be accounting, but some practical application probably. But anyway, so when you're looking through this, just the idea is, well, there's some theory here, okay? So how business works, and they throw the triangle up here. It's kind of interesting, isn't it? Here's a slide on how business works, and the first thing we talk about is fraud. Maybe, right? Maybe. Well, it is kind of about wealth maximization. It is, you know, but I would hope it's societal wealth maximization versus individual wealth maximization. And a commonly held view is if we let individuals get as wealthy as they want to get, then that's going to make society as a whole wealthier. And there is some rationale for that argument, right? You trickle down that idea, right? You get the people on the top really, really rich, and then it'll trickle down to the poorer people, and the poorer people will be better off. There's some evidence that that happens in a real marginal way, minimal way. Okay. But is that really societal wealth maximization? Have a few people be as rich as possible? Maybe not. Okay, so we get into these, it gets into politics, doesn't it, right? In the political discussions, because people have different views. Okay, and we don't really know. But in terms of frauds, it might just be extreme wealth maximization. I mean, myself as wealthy as possible, be stealing from you. What the heck? That's just business, right? And to some extent, we operate business that way, unfortunately, right? Some people think that's just fine. The big banking collapse recently that probably thought was the main factor in the stock market cutting in half and, and people losing a lot of wealth. And there's a lot of people stealing, right? Rigging the game in the stock market. So, innocent people invest in the stock market thinking they're going to do well, and somebody else takes their money away from them. There was an awful lot of that. The housing bubble, an awful lot of that. When Enron folded, right, and ceased to exist, definitely, right? Definitely fraud, right? So, anyway, but what's the deal with fraud? If you think about this, it's going to happen to any of us, right? I have an opportunity to steal, right? Nobody's watching, right? If there are no controls over the business, nobody's running anything, there's just cash sitting there on the table and nobody's watching. All I got to do is pick it up and put it in my pocket. Almost gets that bad, okay? So having the opportunity, obviously, yeah, to the extent people have opportunity. And then the incentive. I think I'm a very ethical person, but I'll tell you what, if one of my grandchildren had a life-threatening disease and I didn't have enough money to pay for it, and I was in a situation where I could steal that money from I don't care who, I would save their life. I would do it, right? So if you have enough incentive, now for some of you, you want a Ferrari, right? That might be your incentive, and that might be fine, right? That one wouldn't do it for me. I don't care if I have a Ferrari or not, right? Okay? But there's something for everybody. There just is, right? Okay, I used to joke that if it was, $500 million in the Bahamas without extradition, yeah, maybe. But a few points on the quiz, no way, right? So I'm not going to price that way too. Yeah, you really. But I'm not going to price that way too, right? No amount of money for me personally. Okay, and I hope you feel that way. And then this one, rationalization. This is the best one. Everybody does it. Do you know anybody who cheats in classes and says that everybody does it? It's just a game. How many have never been in that situation in your life? You've never, ever seen that. Okay. Rationalization is simple. I need it. I deserve it. I'm not being paid enough. Right? I'm worth a lot more than they're paying me, so I'm going to take it. It's just my compensation. Oh, they're stealing from me at work. Right? My boss is stealing from me, I'm going to steal back. I'm just taking what's mine anyway. It's no problem. Right? So, do you think this might be out there in people's heads that are running businesses, that are managers in business? Oh, yeah. This is just really common. Do our politicians do it? Sure. Okay? We can rationalize all sorts of people. Right? So be careful with yourself, right? Think about it. Where am I at on these things? Okay? Is it all about me? Anyway, so what's the idea of corporate governance? Well, you try to ensure the company is managing in the interest of the shareholders. I would say society in general, because if you don't operate in the interest of society in general, you hurt your shareholders. In our society now, maybe that's a good thing that it's developed. What happens if you make your shareholders wealthier and you damage the environment a great deal? Or you victimize your workers, that you make your shareholders wealthy? What do you think?
So does Philip Morris follow?
Real interesting question. Yeah, in the U.S. they're pretty good. They're not killing very many people in the United States anymore. They went international, killing people other places. The tobacco industry. And real interesting, isn't it? Should the industry even exist? But be careful with that. That's a sin I don't do, smoking. But you leave bourbon alone, okay? Bourbon kills people, you do know that, right? And people who become addicted, alcohol kills them. So should we get rid of that industry too? Oh my gosh, we don't want that. Or beer, or wine, in my case, right? Oh, gambling, you take that off the table. I don't like to gamble. All those casinos should be closed because kids are hungry because their parents are addicted to gambling, right? Anybody out here like to gamble? You might think that's just an absurd thing to say, right? It's fun, and it's cheap entertainment relatively. There's all sorts of arguments on all sides of this, right? There's a really neat book on the tobacco industry. It's called The Tobacco Wars. You ever run across it? Well, you run across it. Go find it. Real short. Little pamphlet type book. And they give all the reasons why the tobacco industry is more beneficial to society than its cost. Many states would not have educational systems without the tobacco industry. North Carolina is one of them. This used to be one of them, like tobacco industry gone. But North Carolina is still that one. That's their tax base. Gambling used to be a horrible thing, you guys. You didn't have casinos in every single state. You had casinos in Atlantic City and casinos in Las Vegas, and it was illegal everywhere else because it was a horrible thing. And that's how we fund education systems in a lot of states. Because people want to pay taxes, they'd rather gamble and lose, pay taxes out. Rationalization or what, huh? And so, yeah, and that's a really nice example of the tobacco industry. They're an easy target because we kind of shoved it out of the way, haven't we? But they're still extremely profitable. Okay? By the way, are you contributing to it? If you buy tobacco, maybe you're addicted. But how about if you buy products from companies that fill up more songs? That, you know, they used to own Kraft, I don't think they still do. Anybody ever have Kraft cheese? You might be helping the tobacco industry if you do that. You horrible person. Right? So, yeah, this is tough. It's really hard. Okay. Sarbanes-Oxley is a law that came in to try to strengthen financial reporting, internal controls in companies. Internal controls in companies are procedures we put in place to try to make the company run more efficiently and more effectively. Efficient means less expensive, right? Doing everything the company wants to do. Effective means doing a better job, right? And then part of that, of course, is to safeguard your assets against people stealing them, right? And to protect the shareholders, and to protect the employees, and to protect the environment, and all of that, okay? So a lot of things that management does, and that you guys are going to be managers, is to try and control this huge organization. Even if you only have a couple hundred employees, you're trying to control a couple hundred people. What if you have 10,000? Oh my gosh, right? And I don't mean control in terms of, let's hope not, tell them every move they make, but just keep everybody going in the same direction even, right? Trying to accomplish something, trying to get things done, right? And balancing all the needs of what we would say is all the stakeholders, right? Is the interest of the government, which is us, by the way, right? Government is us. It is. We elect them. It's us, right? So I love it when we all complain about the government. I hate the government. Wait, you hate yourself? You voted them in? Come on. Or you just hate the other people that voted for those people. You voted for somebody else. Nobody ever voted for one, apparently, right? You know, so because I hate the government. Silly, right? It's a silly concept. It's us, right? And by the way, corporations are us. You guys are going to own shares of stock in companies. I own shares in all kinds of companies. I bet I own shares in tobacco companies because it's through faculty and teachers in general retirement funds, right? You know, where I've invested my money, right? And so, you know, I bet they own all kinds of things. I bet they own interest in weapons manufacturers. And I really hate war, you know. So, yeah, you know, it's really a mixed up economy. It's really tough to figure this stuff out. But anyway, the idea of internal controls is to make the business run as efficiently and effectively as possible. Part of that is protecting your assets, don't you suppose? But you got to balance, you know, how much should the shareholders get? How much should the employees get? How much should you give to governments so that they can spend them on society in general? So how much should society in general get? Do you think it's the responsibility of companies to support society in general, or is that society's business somehow? Well, if you believe that, then let's eliminate taxation on businesses, but then let's raise taxation on the rest of us, right? On individuals. But seeing as businesses don't really exist anyway, it's a figment of our imagination, right? A whole bunch of people get together, it's the people. And if you've got millions of people owning the stock, it's millions of people are responsible for everything General Motors does, right? That's sort of the idea of this governance, right? We run it, not the CEO. Well, do we really run it, or is the CEO? Well, the CEO does, of course, right? Sort of. I don't know if anybody runs it. They're so big, right? And if you work for General Motors and you never met the CEO, did you think the CEO is your boss? Really? That's like saying somebody working at the post office works for Obama. What, do they talk to him every day? Right? No, come on. It's not the same thing, right? Okay? Although the CEOs of these businesses make how many times more than Obama does? Some of them make 1,000 times more. Yeah. Yeah, something like that. And there are people making hundreds of millions a year, right? Yeah. I don't know why he took his job. It was a crummy job. Okay, anyway. So let's compete for it. So players in the communication process, management, regulators, SEC, stock exchanges. What does SEC stand for? Securities Exchange Commission. Okay, this is a what? Agency of the federal government, right? The director of the SEC, who nominates him? This is a government agency. Who does? The president does. So this is a powerful person. The president nominates him. Who must ratify that nomination? Congress. This is political, you guys. Okay? And Who funds them? Who can take all their money away so they're totally ineffective? No, Treasury actually writes the checks, yes, but who decides how much money they get? Congress. So Congress can ratify so they can keep somebody from being the chair, right, if they want. They can't nominate one themselves. The president has to nominate them, right? Separation of powers idea, right? And then what? They can fund it or not. What happens if an SEC chairman does things Congress doesn't like? They get their money away. Yeah, and they threaten to do it. In the Enron fiasco, when Enron and WorldCom and all those companies went down, guess what? The chair of the SEC wanted to stop them from doing the things they were doing, the ones that were legal. Right? They were doing some legal shenanigans too before they started doing illegal ones, right? They're getting away with murder legally, right? Stealing. Okay? Making things look different than they really were. Smoking mirrors, kind of. But legally, right? Following generally accepted accounting principles that were required by the SEC. So the chair was saying, no, 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 or allowed at least by the SEC. So the chair was saying, no, we got to stop this, we've got to stop this. Guess what businesses did, big businesses? We don't like this. Guess who they talked to about not liking it? Congress, their representatives and senators. Guess what Congress did? They threatened to remove funding for the SEC. And then the chair of the SEC backed down. I saw an interview with him where he said that's the biggest regret of his entire career, that he didn't get fired. He should have resigned in life. And he didn't. He tried to make it work within the system. And then Enron and WorldCom and all those fraud stuff happened. You were not considered part of the company. This is the example. You were not considered part of the company if at least, I think it was at that time, 3% of your stock. Now we've really improved it at 7%. At least 3% of your stock was owned by someone other than your company. So your company could own 97% of another company, but you didn't have to put the financial statements together. You just read about consolidations, right? You didn't have to put them together with you. If somebody else owned at least 3% of it. What do you think of that? I own 97% of something, you only own 3%. I don't really own it. You do. What do you think? Give me a break. That's absurd, right? Now it's 7%. Would you still think it was good? You own 7, I own 93, but really, you're in charge. It's your responsibility. So let's do separate financial statements. Then what we do is I take all the profits, you take all the losses. I get the assets, you get the liabilities, and I don't have to put expenses, losses, right, on my income statement. I don't have to put liabilities on my balance sheet. I can look like I'm real profitable, and guess what? I'm not. That was the beginning of Enron. Everybody got the idea? And this was generally accepted accounting principles, right? What are you going to do, right? How are you going to stop it? So people think accountants are these safeguards, CPAs are these safeguards against fraud. Well, that's not fraud, so I guess we are, right? By definition, that's not fraudulent behavior. Reporting it that way. Everybody got the idea here? This is political. It's a mess, okay? But you keep trying, you keep working. Okay, anyway, and the SEC tries. How much money do you think the SEC has compared to corporations? Seeing as it's federally funded. Nothing. They don't have any people. It's like the IRS. Now we're critical of the IRS. Did you see this thing on 60 Minutes yesterday? Where all you have to do is steal a social security number and you can get a tax return for income that was never even earned. Because you just forged, you don't have to send any documentation in anyway. And you know what? The electronic filing is saving us a fortune. Probably the theft is less than the savings we have in having electronic filing, even though people are stealing big time. Wow. It goes back to that fraud triangle, doesn't it? Opportunity, motivation. I had a guy with those folks even have to rationalize it. It's all right. Everything's fine. Okay, anyway, so we tried. The FASB, Financial Accounting Standards Board, this is a group quasi-independent of the profession, quasi-independent of the government, that tries to write accounting standards. They have money, right? Because businesses and the accounting profession give them the money. Okay, not the government. So they have this permanent source of financing, and they then have people who can write generally accepted accounting principles. Does this make sense, guys? They've come up with the generally accepted accounting principles. Okay? So they're called FASB statements. So the SEC, listen to this carefully. There might be a question on the quiz. I'll give you a few easy questions on this. The SEC has the right to issue accounting pronouncements. They rarely do. Why? They don't have any staff to develop one. So they let this quasi-independent organization, sort of profession, users of the statements, you read about it, right? And government influence, right? They let this FASB group write all of the statements. But anytime the SEC doesn't like a statement, what can they do? Write one of their own, and guess which one takes precedent? The SEC. It's happened a few times since. Okay? The oil and gas industry they didn't like it. In fact, they did, and they got it override. Actually, APD at that time, they the same idea. They became precedent for it. They got to replace with what they wanted. Right? Durham. Okay? So, all right. And then this one's on auditing. Oh, I'm sorry, there's a question. Go ahead. There you get it? Okay. Public Company Accounting Oversight Board. We're not supposed to call it peekaboo, wouldn't that be good, though? Yeah, anyway, the peekaboo doesn't like to be called peekaboo, but people call it that. Not to the face, though. Public Company Accounting Oversight Board. This was formed after Sarbanes-Oxley. This one was. And, by the way, who's Sarbanes and Oxley? One was a senator, I think, and one was a representative. I'm pretty sure. Right? It's an act of Congress, right, that went through to try to solve the frauds. Every time there's a bunch of frauds, it seems like every 10 years we have a whole bunch of frauds, around 10. And then everybody gets all excited about stopping fraud, and then by 10 years later, nobody's worried about it anymore, and we have a whole bunch of frauds. And it's just crazy within the profession, the accounting profession, and business community in general, okay, and society in general. Okay, but anyway, this one came from the last go around, okay? And what they do is they write auditing standards. It used to be that the accounting profession wrote their own because they do the audits, right? CPAs do the audits. Well, now this quasi-independent group has got people from the profession, people from the government, that sort of thing, put together, and they write the auditing standards. And what's really cool about this is we have reviews. It's called peer reviews, which is where another CPA comes in and looks over your work, right, from a different firm or something. It used to be our EY would have somebody from Pricewaterhouse come over and look at their stuff and say it's okay, and then the reverse was true. What do you think? That good old boys network, good old boys and girls network, I guess, the women involved too, right? Now, yeah, still, how independent. What this is a whole bunch of retired partners who don't care about anything but people following, doing accepted accounting principles and doing good audits, right? Following the auditing standards, they come in. Now it's got key, right? And if they object to what you're doing, they can take away your right to do audits of SEC companies. Now it's got key. Okay, so that was a really good step, having this, writing the standards better. The auditors are supposed to be independent CPAs, separate from the business. The business is run by the board of directors who hire the CEO, right? Chief Executive Officer, CFO, Chief Financial Officer, Chief Operations Officer, right? They hire the top people, and then they hire all the employees. So really, the board of directors, who are elected by the shareholders, right? The board of directors are responsible for running the company. Really, okay? Yeah.
Has the PCAOB ever taken away a right on the auditing firm?
Yes. Yeah. Smaller firms. It's temporary until they get training and not a big four. But the big fours pay a lot of attention to what they have to say. All they need is an article in the Wall Street Journal saying that EY had substandard audits. No, there's no way. They don't want that. Okay, so they treat them real well. They do not call them peekaboo to their face. Let's put it that way. It's not a real friendly environment, right? It's not real hostile. It's horrible. And they're professional, but the public company accounting oversight board is really independent of the CPA firms and of the companies and of the government and of everybody on earth. There's nothing like retired people who aren't going back to work again. There's nothing like that. As long as they still have a mental faculties. I'm an example. I'm not retired yet, and I don't have a mental faculties, right? Yeah, anyway. So, no fun. Any more questions? Comments? Kind of interesting stuff, though, I think. A little different for us here. Okay, anyway, you know about this, don't you? There are 4 basic financial statements. Oh, you know what? Everybody needs to know what a Form 10K is and 10Q is. You know why? Because nobody says annual report, they say 10K. Have you looked at the 10K? Now you know, right? Buzzwords, right? Okay, now you know. Call it 10K. What's a 10Q? K's annual. What's 10Q? Quarterly. Okay. What's an 8K? No. No. What's that?
Isn't it like they file at the odd and stuff or different?
Yeah, you have a change in the CEO, you have a major change in stock ownership, you have something really huge happen to the company between the quarterly reports. Do you want to know about those things? Oh, yeah, you want to know about those, so that's a good one to know about too. Okay, anyway, yeah, and these are required for companies who file with the SEC. And by the way, what can't you do if you're not filing with the SEC? You can't list your stock on New York Stock Exchange, American Stock Exchange. You can't trade your stock across state lines. Do big companies want to do that? Of course, right? Even a lot of small companies, so you register with the SEC. Is it expensive to register with the SEC? Yes. By the way, where do you think the SEC came from? Securities Act of 1933 established the SEC. What happened about that time, like in 1929? The stock market crash. By the way, that was not the first round of frauds. We've been doing it earlier than that too, right? Throughout history, really, right? But in the U.S., that was a big one, and really around the world, that was a really huge one, wasn't it? Okay, all right. So, our grandparents' lifetimes, my parents, your grandparents' lifetimes, right? So, yeah, that was really big. So it was all the accountants' fault they put in this SEC law. Anyway, 1933. And then there's a 34 Act. What the 33 Act is initial public offering. You guys know what an IPO is, initial public offering? There's another term people throw out, IPO. It means initial public offering. The first time a company sells their stock on an organized exchange, right? A national or international exchange. Got the idea? So with the SEC, you're registering your stock for the first time. You can even go to jail if you screw up an audit on that. I'm not kidding. Fines aren't this big. You can go to jail if you intentionally, right, screw things up on one of those audits. It's to protect investors, right? Okay? And then in 1934, they decided, well, 1 year later, that's not enough. What about companies who already exist? So that's where they came up with the 10Ks and the 10Qs. Got the idea? That they start requiring annual, maybe 10Ks at that time, start requiring annual. So it's periodic reporting. Which one do you suppose has more impact on companies? Initial public offerings or every quarter? Probably every quarter. Yeah, everybody has to follow that. You don't do initial public offerings except once, right? Okay, so first time out. So anyway, and then there's the four statements. What are they? Income statement, balance sheet, equity statement, which includes the retained earnings, right? And a statement of cash flows. Those are the four. Okay, excellent. And then the notes. The notes, you know what? Those four statements will be 4, 5, 6 pages long. So, right? How long do you think the notes are for companies? 50, 60. I'm not kidding. There's just an incredible amount of information in the statements, or in the notes of the statements. If you were going to invest real money in a company, you think you wouldn't read the notes? Where would you put bad news? If you had a choice, I can either put it on the face of one of the statements, right on the piece of paper, or I'm allowed to, if I want, just put it in a note. What are you going to do with the bad news? It goes in the notes. Because people are stupid. No, say, I'm not supposed to be so stupid. I have grandchildren, right? Sorry. Don't say stupid, you guys. It's bad. Okay, anyway. So you're supposed to say ignorant. Ignorant. The Kentucky speak ignorant. Yeah. Ignorant. Yeah. Anyway. Okay. Anyway. So I think it's from the West Coast. So sorry. Anyway. So they're assuming you're not going to read those, huh? If you're going to invest real money, come on. If you're going to be a finance person, do you want to look at a bunch of ratios, or do you want to actually read the financial statements? Read the statements. Ratios are fine after you read the statements. You want to read the notes too? Only if you want to know what's going on. There's an incredible amount of information there. And you want to look at everything you can possibly find besides that. And then there'll be a report of the auditors. An auditor's opinion on internal controls and an auditor's opinion on financial statements is going to be attached. What if that opinion says everything is not okay? Don't invest. These statements do not follow the generally accepted accounting principles. What do you think if you saw an auditor's report like that? Don't invest. By the way, any publicly listed company, what are their financial statements going to say? Everything's fine. In our opinion, everything's fine. An unqualified opinion, right? Why would the auditor's report say that? Because if they get a different one, they are delisted on the stock exchanges. The auditors have some clout to it. If you give somebody a qualified opinion, something's wrong, or much less an adverse opinion, don't trust these statements at all. Right? What happens to the company? They can no longer sell stock. It's over. Right? It's over. So the profession has a little bit of clout here. Of course, Do you want to keep your clients? Would you like to keep the fees coming in? So there's pressure both ways. Now, some people would argue maybe CPAs aren't very independent of the client who's paying $10 million to do their audit. I don't know. Should auditors all work for the government? Would that be a good solution? Well, then the government would take away the funding, we wouldn't have audits at all, maybe, huh? Fortunately. So, bit of a problem. Okay. All right, guys, did you look at these statements? This is now a classified statement. We'll get a little more sophisticated because you were so good on the statement that time. Okay, I had to do on the test. Okay. Anyway, we separate the current from the non-current. You've seen this before. Down under equity, we have contributed capital and retained earnings, don't we? We show the number of shares authorized, issued, and outstanding. If they're not outstanding, it means you bought back treasury stock. We'll go through that. So you need that sort of disclosure there, that information. Anyway, so this gives an example. Here's Apple. This is a real one. Well, condensed real one. Notice it says consolidated up there. What does that mean now? Apple owns other companies. If they own 50% or more of another company, they consolidate with them. Everybody got the idea? You better got it. Okay? So you're looking at a number of companies here. Most large companies own lots of other companies. I once worked on the Memorex audit. You guys know Memorex, right? In San Jose. I once worked on the Memorex audit, and we consolidated a couple hundred companies. Right? And that was in 1975. Not good. A couple hundred companies. Okay? So I have no idea how many they own now. Right? Companies form companies to do different types of things. Hopefully not like Enron did help steel and setting yeah. So Enron formed them to steal it. Yeah.
When you're creating like this, or even I think the question was a statement the income statement. Either way, how do you know like on the assets or how do you know like which ones to put forward first if you back up on is the most?
Oh, yeah, that's great. How do you know what order they go in? The current ones would be obviously what? Less than a year. Yeah, they're going to get used up within a year. They're cash now, if they convert to cash, they'll get used up within a year. Current liabilities are going to be paid within a year. Yeah, but how do you know within that? Which are cash is first and then which one's closest to cash? That's the idea, except people don't really follow it very well.
Right.
But that's the idea.
And I think I had most of my questions.
Same on the liabilities, which one's going to be paid first, right?
Right.
Accounts payable will probably be paid first. So what some people do, though, is they put the big ones first and then the smaller ones, as long as you get in the right category. Okay, yeah, so.
My question was mostly in the income statement, but also.
Okay, in the income statement, it's all over the map. Some people put in the big items first and then the smaller ones. That's all right, I guess, under the expenses, put the revenues first, of course, and then the expenses. Put the bigger ones first and then the smaller ones. Some people put them all in alphabetical order. I kind of like that, you can find something easier, right? But whatever people want to do. Okay, so, but you keep the cost of goods sold, right, separate from the operating expenses stuff. Okay, yeah, good. Notice on here too, they have commitments and contingencies with nothing next to it. What are they trying to do? Encourage you to read the note in the financial statements. It's a commitment or a contingency, it's not a liability yet, based on some contingency. Maybe I'm being sued by some people. Like, you suppose Dow Chemical has any lawsuits against it? How about General Motors with all those keys and emissions? Any lawsuits? Do you think they have a liability on their balance sheet for those lawsuits? No, they haven't lost yet. So what do they have? Or if they've lost, they've settled and paid it off, right? Where they have lost. So what's the deal? You have to read the note to find out how big the lawsuits are. Trust me, it's huge. Doesn't mean they're going to lose, but right, they're huge.
When they settle, when they pay out, it would then go on there.
That would be a loss on their income statement. Or if they owe it and haven't paid it yet, that'd be a liability. They'd have a loss on the income statement and they'd have a liability on the balance sheet, right? If you owe people money, where's it going to be, guys? Liability on the balance sheet. That's one thing I should mention to you guys too. Don't get the feeling because you have a little trouble on a quiz or a test or both that you're not learning anything. You are. I'm just wanting you to use it. Okay? I need to learn a lot. You know what I'm talking about, don't you? You read this chapter, you can understand it, don't you? You're getting some benefit out of all the work you've put in so far, right? And you're going to get a hell of a lot more before we're done, okay? That's what I want. I want you to know what you're doing, huh? So when you pick up a financial statement, you can read it. So you go off and you do your advertising career, or whatever you do, right? Okay? Whatever you end up doing. You do marketing, do human resources, do whatever. You can read a financial statement. now you can be part of the management team. If you can't read a financial statement, they don't want you, right? But I'll tell you what, I've mentioned this to you before, if you know absolutely nothing about marketing, you're not going to be part of the management team either. And if you don't know anything about human resources, you're not going to get managed in any area. Accountants actually have to be managed. Isn't that amazing? Right? Same management tools that you would use, human resource tools that you would use in any environment. Okay? So, yeah. So do engineers. Engineers are really hard to manage. So are accountants. Okay, there's that income statement. And this one, oh, by the way, public companies, 2 balance sheets, 3 income statements, 3 cash flow statements, 3 equity statements, 3 years. Okay, for public companies. So you see they got 3 in here, right? And oh, by the way, all these, it says in millions on all the statements. Yeah, they're dropping the last 3 zeros. This is a pretty big company. That's not 108,000. What is it? 108 billion. Is that what it is in sales? Or is it 108 million? Yeah, they're in millions. It's billions. Yeah. Okay. Yeah, it's a big company, isn't it? Okay. So yeah, we have huge companies. So this is the classified statement. Sales less cost of goods sold, and we'll get into what net sales is. Sales less sales returns and allowances, less sales discounts. Fine. Operating expenses, operating income, you get used to these terms. Other income and expense, these are non-operating items we'll have down here. We'll talk about that stuff. Income tax expense, provision for income taxes, down to net income, and then we do earnings per share on net income and anything thereafter. So, yeah. And this statement could even get more complex than this, but that's the basic statement, okay? So, this is for a manufacturer, a merchandiser. If you're a service industry, right, we know what the difference is, don't we? A merchandise firm, somebody who sells merchandise, they manufacture things, or they buy merchandise from somebody else and sell it, right? They have cost of goods sold, don't they? Right? Inventory and cost of goods sold. What if you're a service firm? You don't have sales, you have service revenue, don't you guys? Right? And you don't have cost of goods sold because you're not selling a product, a good, right? You're not selling a good, you're selling services. So they wouldn't have cost of goods sold, and they wouldn't have gross profit. It would just be all expenses listed. They have sales and all their expenses come down to net income before tax. Okay? We got it. So good to look at some real statements a little bit. By the way, you can go out online, Yahoo Finance, MS Finance, and you can look up any company you want. It'd be a good thing to do. Pull up their financial statements and see what a real one looks like. See how long they are. Don't read it. Just read it. Take a look at it. See what they look like, what it feels like. She was an executive MBA. You read a whole financial statement, haven't you? Because she had me making her read a whole financial statement. It's painful, isn't it? They were trying to tell me all about a company. It's really fun. It's exciting. You know, tear the company apart and tell me everything about it. Wow. That's big, you guys. It's really big. And it's a neat career. You want to go into financial analysis, right? It's a lot of work. Right? It takes a lot of skill. And some of our finance folks sitting here will probably do that. They show you how to calculate earnings per share. It's the average number of shares that were outstanding. What does outstanding mean again? They're out there. So what I might do is I might have 1 million shares authorized. I might issue 500,000 of those. And at that point I have what? 500,000 issued and outstanding. What if I buy back 10,000? That's treasury stock. They're not out there anymore. I'm holding them. I went and bought them in the stock market as treasury stock. Now how many are out there? 500 less than 10, 490. That's it. So outstanding shares. You take the outstanding share, average outstanding shares, and divide it in. It's the weighted average, really. Okay? Gross profit percentage. Let's not do that. Oh, but let's do this. We'll do the ratios later, right, guys? Towards the end of the class. Statement of comprehensive income here. Okay? 3 different ways that you can do this thing. What's a statement of comprehensive income? See, this is terrible. Right after I give you a hard test, I have to tell you I lied to you again. Assets equal liabilities plus equity. Revenues less expenses is net income. It's a little white lie to make things easier as we went. There aren't 2 types of equity, there are 3. You guys know about contributed capital, right? Common stock, preferred stock. You can go through that stuff in a little more depth. By the way, the rest of the class is just using what we learned in the first 4 chapters to do different areas of the business, okay? This next chapter is cash and accounts receivables and sales, that sort of thing, okay? And then we're going to do an inventory chapter, okay? So it's just one part of the balance sheet after another, and the income statement too, and trying to get deeper understanding, okay, understand more areas. So we have contributed capital, we have retained earnings, we have one other comprehensive income. And what this thing is, are things we couldn't get an agreement, a political agreement on what to do with them. I'm not kidding. We didn't know where to put them in terms of, can I get them on the income statement? Should they be on the income statement? Revenues and expenses that or gains and losses that maybe should be on the income statement, but people didn't like it, right? So we have these political compromises that result in having something called other comprehensive income. And they show some examples here. We're going to do these available for sale investments. These are investments I'm going to hold for more than a few weeks. To be called trading securities if it's longer than that. What do I mean by investment? Stocks and bonds of other companies that we own. And you don't have to remember all this at this point because we're going to do it, right, in a later chapter. Okay? But trading securities, we think, are only going to hold for a few weeks, a few days to a few weeks. Okay? Investments in other companies. Real temporary. On trading securities, I would have the trading security as an asset, and I record them at their market value. I keep them at their market value, not their historical cost. You know what those things are now, right? Market value versus historical cost. And then what I do is the gain or loss would be a gain or loss on my income statement. So it actually end up in retained earnings. Well, nobody likes that. They don't want those gains and losses because the stock market fluctuates, right? The gains are fine, but the losses are annoying, right? Yeah, you don't want to put those losses in your income statement and retained earnings. So what the agreement was if it's more than a few weeks, it's called available for sale. Guess what a short-term available for sale is? You're going to hold it up to a year. Guess what a long-term available for sale is? You're going to hold it for more than a year. Yeah. But in both cases, we're going to adjust them at the end of each year to fair market value. Well, that's fine on the balance sheet. In fact, it's good on the balance sheet. Why is it good to put them at fair market value on the balance sheet? Because that's what they're worth at the end of the year, right? It makes sense. These are publicly traded stocks, right? If I own some General Motors stock, I know what it's worth at the end of the year, right? It might be worth something different the next day, of course, right? It could go up or down, probably will, right? Do one or the other, right? But I know what it's worth that day. Just have a snapshot of what it's worth for my balance sheet. I can put that on the balance sheet. But what do you do with the gain or loss since the last year? Well, nobody wanted to put it on the income statement, so they put it in other comprehensive income. If it's a gain, that's fine. It's more, right? Equity. If it's a loss, though, it's going the other way. And so it goes directly in there. And then there's cash flow hedges, right? So hedges gives cash flow. This is foreign currency translation stuff, right? Currency translation differences because the value of dollars, U.S. dollars, changes at a different rate than the value of euros, for instance, or the value of yen. So you have foreign currency gains and losses. I don't know what to do with those either. They end up being the same way, okay? We adjust the assets and liabilities to their fair market value, basically is what happens, but the gain or loss on that goes in here, and all of these are that way. Pension plans is another huge one. Here's what the deal was. A whole bunch of companies had pension plans where they guaranteed their employees a certain retirement and never recorded the liability. So they never debited pension expense and credited the liability while the people worked through their careers. And guess what happens? They owe a fortune. In some companies, they owe all the retained earnings to the employees, basically. And it's really big. So nobody wanted to put those losses, take those losses out of retained earnings. But they wanted to record the liability. Make sense? So they got the liability recorded now, but guess where the big expense that never got recorded ended up? In other comprehensive income. So this is kind of this political deal that works out. Now, for this particular company, this is Lenovo Group Limited. Look what happens. Here's their net income for the year, but when they consider all these things, this is their comprehensive income. Now, it's not a big deal to remember this, but I think it's kind of interesting. This other comprehensive income stuff, this stuff down here, you can show this comprehensive income a variety of ways. One is you could put it right on your income statement. At the bottom of the income statement, you put that stuff, just like they're showing here, and it would be a statement of comprehensive income then, okay? Everybody got the idea? So you could, but you could show the rest of the income statement above it, right? So it'd be a whole income statement inclusive. Well, nobody does that. Why? They don't want that on their income statement. They're not going to put it on the bottom of their statement. So guess what they do? They do a regular income statement, and then they'll do a statement like this, maybe. That's the second way you could do it, where you have other comprehensive income items on a separate statement. Okay? So you need to watch for that. Guess what the most popular way of doing it is? You go straight to the equity statement, you don't have a comprehensive income statement at all. On the equity statement, you have columns for contributed capital, common stock, right? Preferred stock, additional paid-in capital on both. Then you have a column for retained earnings, and then what do you have? A column for other comprehensive income, and then a total equity column. So where do you go to find this for most companies? In their equity statement. What are they probably hoping? You won't read the equity statement. Oh, so is an equity statement important? Yeah. Okay. So we must be extremely boring, I'm sorry. People are leaving. I don't want to know this stuff. No, I'm sorry. Everybody's time is their own. Okay, so here's an equity statement, an example of it, but this is only partial. Why is it only partial? Well, you're showing 1 year. So imagine, and also they really simplified it, just common stock retained earnings. They don't even have the other comprehensive column here, which you could have one in here, right? Okay, and then this is just 1 year, and going down the page, you do 2 more years. Does that make sense? So it turns out to be a really big statement, usually 2 pages wide and a whole page long, right? It's a monster. Okay. I won't make you do one of those that looks like that. Those of you who become accounting majors get the thrill of that. And then cash flows. Remember, we're going to do cash flows in a later chapter. And we'll go beginning to end. I'm going to actually have you prepare a statement that looks like this. But by the time we get there, this is not going to be a big deal, and I'm going to give you a whole bunch of points for doing it. That's nice. Towards the end of the class, and you're going to really understand how a cash flow statement works. And I mean, like, it's going to be a whole quiz, or at least half of a quiz, and then it's going to be a quarter of a test, and then it's going to be a question on the final, and it's 1 problem. You don't have to do 1 problem. But it's a big one. You see, you separate things into operating activities, investing activities, financing activities, and all this statement does is shows the beginning cash down to the ending cash. You know, cash in and cash out. It's like this. Beginning, in, out, ending. That's what that statement does. I'm not kidding, right? We know what the answer is before we start. It's really cool. This is so easy, right? Increase or decrease in cash, right? It started with beginning cash up here. There's a couple ways you can do this. You can start with beginning cash here, add or subtract the change in cash, and get ending cash. You know those 3 numbers, right, off your balance sheet before you start. So you know what the answer is before you start doing the problem? Like problems like that? I already know what the answer is, and now I just work until I get the answer. Put things in the right place. It's really simple. Really simple. Quite a few numbers, but simple process. Okay. The notes, what do they do in the notes? Descriptions of key accounting rules, principles, we should say not rules, applied to the company statements, additional detail supporting reported numbers, relevant information that's not on the face of the statements. Isn't that cute, that little page down there? Differences in accounting under IFRS, International Financial Reporting Standards, and US GAAP you read about. There are some really big ones that are holding up us doing the same type of accounting the rest of the world does now. 100 countries have adopted IFRS, over 100. We're one of the few that has not, but we have a huge economy, right? Our big reason for wanting to adopt IFRS is companies are starting to list on international stock exchanges instead of ours because they don't want to mess with our US GAAP. We need to have our GAAP section, right? New York Stock Exchange and American Stock Exchange are really pushing for this. But anyway, this is a big one. LIFO, we permit it. It's silly. You're going to find out about that when we do inventory, right? They prohibit it. And that's a big one because our Congress does not want the rest of the world, the French, basically, right? We don't want the rest of the world telling us how to do our accounting. And we have to change law, not just accounting principles. Law, into our tax code. Right? They can use LIFO. So, yeah. Anyway, there are other ones that are a problem. This is an annoying stereo, probably blunt equipment, but yeah, so there are some differences, some key ones that need to be resolved still. There used to be a lot more. We've been working on them. So, good. We'll do that later. Good deal. Let's leave Nicole 1 minute. Be working, you guys. Get chapter 6 read. Be wired, ready to go. Do some homework. Get yourself focused. You were really good today. That's in a way. Paying attention. That's nice. I know it's your love of learning and not your fear of failure, right? Those are all mixed together, and I think those are mixed together.
You probably do plenty of investing.
No, I do not. Isn't that silly?
Really?
In the MBA, but kind of. But, and even in intermediate accounting, I talk about major finance methods. I don't have time. I don't have time to
What do you do to scale it up?
it all goes to my wife spends my money. But it all goes, if she spends her money, it's not mine. Or, yeah, anyway, no, yeah. I don't make that much, really, and we like to live well, and so we pretty much spend everything, but we put 15% of what we make every year into TIA credits, and they manage the money and charge almost nothing to manage it, and they do a really nice job. So it's the professors put their money in. It's not a pension plan because you're not guaranteed anything. It's an investment plan, and the returns are really nice. They're as good as the stock market as a whole, even after paying the fee. So that's more
good advice, though.
I would never give you any advice, but when you take intermediate accounting,
Right.
I will show you some really cool, a really cool method. Oh yeah, it's only the next class after 1 or 2. Just do one more.
No, I'm
and then later you maybe so.
I got it in May.
Well, maybe do it this summer. That'd be cool. Where are you going to work?
That's a question. Hopefully for a German company called Tenta up in Cincinnati.
Doing what?
And I'm going to be directly into director of sales, corresponding with Germany.
Oh, fantastic.
Can't wait.
Well, that's cool.
I'm a sales
Become a
guy.
CPA later.
I'm disorganized and.
You can't be a salesman and be disorganized.
Huh? No, you know what accountants say? The sales, like, every company
Nah.
starts with sale. My dad always told me, he's like, you are so disorganized compared to me. I'm like, you're right.
We weren't here on Friday, so we never got this back.
What did I do with them? This thing up. Oh, escape. There it is. I just remembered I'm still recording things. I think I am anyway. Recording, giving people a hard time.